Hey, good morning, everyone. Marty Mazzora here. It's the 18th of January, 2025, with your end of week market and economic update. I'm going to not take too much of your time this morning. I'm just going to highlight the important or key events of the week. Going to share the kind of summary of more or less equity market conditions as I put them in our log yesterday, and run through a half dozen or so charts with you. We'll look again at stocks, the dollar, the yen, yields, and take a quick look at gold. So just jumping right in, let's take a look at yesterday's note. So the point I make here is the start to 2025, albeit nascent, right? We're just getting started, has been telling in terms of what's driving financial markets, equities in particular. Last Friday's swoon on the good jobs number and this week's rally on somewhat tamer than expected PPI, more so PPI than CPI in terms of tamer than expected, and barely worse than expected retail sales, although in our index we also tracked the weekly Red Book retail sales, and they actually had a pretty good drop in terms of their year-over-year growth rate. And then, not to mention, but definitely should mention, very dovish commentary from a Fed member who I think really is eyeballing the chair position here when Powell's tenure finally expires. But, nevertheless, this gentleman has turned very dovish and very accommodating for the markets and policymakers and so on. And the market definitely responded, I think, to his comments. In fact, staying with that, prior to his comments, it was all the way out to September before futures priced in 100% chance of a Fed cut. Right after he spoke, that got pulled forward to July, and the market loved that big time. So essentially all that says that good news is bad news as it signals to the Fed that there's no need to cut. So good news, for example, being the better than expected jobs number. And that bad news, or maybe soft news, is good news as it tells the Fed that, yeah, go ahead and cut. i.e., stocks right here at these very elevated valuations are unequivocally discounting lower rates going forward than we have right here. Now, MRB Partners, one of our research resources, while they acknowledge that higher rates are a headwind for equities, they actually believe that global economic activity is going to pick up this year, and the resulting earning strength will be sufficient to buck the higher interest rate headwind that would accompany such growth. I, for one, am not all that sanguine in a higher interest rate scenario. Now, they do acknowledge that the current cycle will ultimately end in recession, as do we acknowledge the same. The challenge, of course, being the timing. And here's from their latest macro commentary. The economic cycle and bond bear market, yields rising, bond prices falling, will only end when the weakest links finally snap and start the process of pushing down the dominoes that will result in the next global recession. The challenge has been to time such an outcome, and at what level of U.S. Treasury yields. For now, most economic canaries are still singing. We expect new highs in Treasury yields this year, which will drag up other developed market sovereign yields. Periodic bouts of lower bond yields and risk on will help to prolong the cycle. Risk on meaning rallying in equities, for example. And that's what happened this last week, and I'm going to show you some charts. Yields popped lower and equities popped higher. Now, back to my commentary. That last line is essentially what I've been saying to clients. When the data begin to soften, yields will react lower and equities will catch a very nice bid. If when the data accelerate to the downside, read recession, that's when this incredibly long cycle, uptrend in equities, etc., meets its end. And that's what MRB is saying. As today's corporate earnings expectations and equity price levels don't remotely discount recessionary conditions, and I cannot overemphasize how they do not discount anything remotely like a recession right here. On the flip side, as MRB suggests, if indeed the economy runs through 2025 without a measurable slowdown, The resulting high and rising yields simply don't allow for sustainable and meaningful U.S. equity market, and that would be the cap-weighted averages like the S&P, that is, gains from here. And should that scenario morph into a 2022-like bear market, given the market exposure, all-time record, within consumer portfolios right here, an economic slowdown could come at the hands of a protracted equity market sell-off. So the theory of reflexivity would suggest that not always does the stock market represent economic conditions. Sometimes the stock market can actually force economic conditions. So if everybody's all bulled up in stocks and those stocks begin to take a hit, particularly when all of the heavy lifting and consumption really is coming at the hands of the upper 60% of income earners and the people who own stocks, if suddenly their net worths decline notably because of a stock market sell-off, which ultimately is going to come, I don't think anybody argues that, it's just when and by how much, that could really do a number on consumption. Now, I thought about getting into the weeds of some of the earnings call commentaries and just corporate commentaries in general, because the folks like BCA, who actually expect a recession this year, are bringing out these commentaries that suggest that the consumer is really rotating to cheaper value items, that folks with six-figure incomes are shopping at Walmart, and that's what's keeping Walmart going, is that people with money are actually trading down to Walmart for their goods. And so there's a lot of that, and it's pretty compelling. But then again, I read almost an equal amount of companies in other spaces like travel, leisure, and entertainment that are just killing it. And their projections are that they're going to continue to kill it. So when I go through all of it, I kind of just say, it's a mixed picture. Clearly, folks with money are keeping the economy alive. Folks without money are suffering. Ultimately, we're going to see things break in one direction or the other, and I have my concerns. But as it stands right now, I can't really make a compelling argument that things are about to roll over tomorrow based on what I'm reading in those commentaries. We'll take that for what it is, and definitely concerns there. Something we should not overly discount, something we should not ignore, like many of the folks who, pardon the sarcasm, but the perma bulls will only trot out the positive stuff. The bears, and I'm reading a lot of their stuff, will only trot out the negative stuff. We have a responsibility to the folks whose money we manage to be objective and to test our theses and to not succumb to innate biases, which I see this in this market. I've been seeing it for 40 years, and trust me, it's not that easy to overcome it. Okay, so next slide here. Macro hedge funds have been slashing their equity exposure. So we kind of operate like a macro hedge fund, if you will. We're not a hedge fund, but we do hedge our portfolio, and we do go anywhere and everywhere where we find opportunity and value. And you can see that of late, macro hedge funds have been cutting their U.S. equity exposure quite precipitously here. Now, that kind of speaks to sentiment. So one thing I've noted here is that advisor sentiment has literally fallen off a cliff, right? So this is the spread between the bulls and the bears, and it's somewhere around 11 or 12 is what it looks like right here in favor of the bulls. But that's very low sentiment. So you see, it's the lowest it's been in about the last 2 years. Now that's actually a bullish contrarian sign, right? Notice how low it got here. The market rallied off of that. Notice it was way up here in the clouds, and the market took a bit of a dip. When it fell out of bed, then the market rallied. Same kind of thing here. You can see that throughout history on a short-term basis anyway, that when advisors get too far on one side of the boat, you get a little news and suddenly you get that fear of missing out. And that kind of explains, I think, this week's action, is that there was a lot of bearishness. There was a lot of short exposure in the market, meaning folks betting that the market was going to fall. A lot of put buying, forcing the dealers who sell those puts to short the underlying security. All those shorts had to be covered starting Wednesday, really, with that softer than expected CPI number. and then on Waller's comments and so forth. And I think that pretty much carried through to the rest of the week. And then, of course, if people get bullish all of a sudden and they want to express that with call options, then the dealers who sell the call options have to buy the underlying security, and that just creates more upside oomph. So make no mistake, folks, in this environment where you have this kind of volatility, it's largely about positioning under the surface and flows, probably more so than actually underlying fundamentals. In fact, I personally would say certainly much more so than the kinds of things that you would really build an investment thesis around. Okay, so we'll leave that there. There's more I can ramble, but let me start with what I think are some positive developments. So I've been talking for a long time about how abysmal the breadth readings have been, and December was no exception. January suddenly is looking a lot better in the first couple of weeks. We have the S&P equal weight and the NASDAQ 100 equal weight leading the cap-weighted indexes. Okay, so we haven't seen that very often in quite some time. Now, when I do take us back a year, we can get a bit more realistic on this, and we can still see that short of the last couple of weeks, we still have massive outperformance in the cap-weighted versus the equal-weighted indexes. And so that tells us that the rally has been, save for the last couple of weeks, has been hugely concentrated in a handful of stocks. But again, my point today is that short term, it's looking a little better. Also seeing that on the S&P 500 advanced decline line. So here you see the market just getting back to this level where it was on January 6th. But the advancers each day are leading the decliners, the stocks, number of stocks going up versus going down, quite measurably, and with a very bullish divergence relative to that. Otherwise, for the last couple of months, it's just improving. It's not that compelling, but it is encouraging to see a widening in the market action. From the perspective of the 50-day moving average, we were in the gutter. The market was here at all-time highs, and we were at like 20% of the stocks in the S&P were above their 50-day moving average, with the index above. Again, speaks to that concentration. The index just poked back above its 50-day moving average yesterday. That's bullish, technically speaking, potentially. And you can see this is improving. So that's a good sign. You still want to see, more than half, much more than half above the 50-day moving average when the index is there, so it's not great. But I am pointing out to improvement there. On the 200-day moving average, we haven't really threatened that since a year ago, right? And so quite the gap between the price and the 200-day moving average, and just now moving back into 60, 61% of members above the 200-day moving average. Still not great breadth. I still think we'll have a bearish divergence here if indeed we get to new all-time highs anytime soon, but it doesn't necessarily have to be that way. It could be just a rip-roaring rally, but it would have to be very broad-based, and that's not what we've been getting by and large over the past couple of years anyway. Okay, and then one more. I haven't shown this in quite some time, but I need to show it now because of what we're seeing. So this is a chart that I created a while back. Actually goes all the way back to the Great Depression. And I'm just here featuring the last 45 years or so. And what you have here are these bands. So this is the daily rate of change, this yellow here, of the S&P 500, right? And I have bands at 1% or 2%. So what we want to look for is when the rate of change breaks through the 1% line and comes close to or breaks through the 2% line. So we're looking for periods of intense volatility in both directions, not just down, not just up, but in both directions. And then what do we get in terms of price action, typically coming into, during, and coming out of such volatile periods, if you will. And clearly what I'm doing here is I'm highlighting this as a warning signal, right? If we go back here to the 70s, you can see just heading into this 16% declines that happened coincident with a recession in the early 80s, that is. You can see that we had just lots and lots of volatility. So in a few short years, we had a couple of pretty decent declines. Came down 15% in here while we were just kind of battling around. But the point here is the market tends to do much better on a sustainable basis when the day-to-day volatility stays contained within these bands pretty tightly. Once it begins to break out of these bands, you need to think about the prospects for something breaking. There was a 1987 crash, 20% in a day or so. Here we were vibrating, kind of shaking the screws, if you will. And then we had an 18% decline during that kind of mild 1990 recession. And then the 90s, just very little. We had our pockets in here. We clearly had some corrective action when the vibrations, began to get more intense. But then as they got really intense here toward the late 90s, we had 10% decline, 20% decline, and just lots of volatility before ultimately a 50% decline. So this is just think of it as just a shaking that was occurring pretty consistently. And finally, the rivets started popping and something broke, right? Here we were heading into, '07, and then really getting volatile. And here we are at all-time highs, right? And then kaboom, a 57% decline in the S&P. Here, that period that encompassed the European debt crisis, amid all this volatility. And as it began to tame, the market began to tame. Got volatile in here. We had 15 and 16% corrections. Started getting volatile here in 2018. 10% and 20% corrections, calmed down a bit. And COVID, kind of shocked the world right here. And obviously this represents the COVID, but we had some vibration action going in there. And then, it took a while for things to calm down. Quite a bit of volatility in here. And then heading just right around early 2022, the volatility began to pick up, and then kaboom, we had that 30% peak to trough decline, roughly 30%. And anyway, folks, and here we are in here. So this has our attention, is all I'm saying. And if we run this back 100 years, you'll see exactly what I'm talking about. Typically, when you get lots of movement, particularly through that second band, you've got to begin thinking about and caring about, or maybe having some expectations about something perhaps not so good in the near term. Okay. Again, not necessarily the basis for anything long term, but just a heads up. And you can see where I calculated the declines in here. So when the market is showing this kind of action, again, we're just early here, you tend to see a lot of this kind of action along the way. So again, something to just pay attention to. Okay, so with regard to the technicals, let's just update the daily chart on the S&P. Another thing I did want to point out here, though, that is a positive, is the on-balance volume graph here. So on-balance volume moves the line by the total volume of the day, moves it up when there's more up volume versus down, and down when there's more down volume versus up. So on-balance volume is meant to determine the degree of passion underneath the move. So when you have a market that's sideways, but you're seeing bigger volume on the rallies, that would suggest that there's people are just waiting in the wings and buying, with both fists when the market goes up. So here we have an S&P 500 that from this point to this point, you can see had a lower low, but a much higher low on the on-balance volume. Here you can see we're still down off of all-time highs, and you can see the on-balance volume actually has a little bit of a bullish divergence. So that suggests, something on balance positive for the S&P in the short term going forward. For the things we normally look at, I would say, from this point to this point, we do have a very notable bearish divergence on the MACD, moving average convergence divergence. However, we do have a buy signal right here, meaning momentum has picked up from below zero, and that's typically a bullish sign right here. I do pay more attention to the trends and the divergences, but the textbook would tell you that's a near-term buy sign. So the shorter-term chart is definitely compelling, positively speaking, because we've now recaptured that 50-day moving average. If we can get another day or three like that and then retest it and come back up, we're going to be at new all-time highs for the S&P 500. In terms of the NASDAQ 100 index, we've now recaptured that all-important 20-day moving average, as of yesterday, trying to show us a buy signal here on the MACD. So we'll keep a close eye on that. Next week's going to be big. as you might imagine, with the inauguration on Monday and a promise to sign something like 100 executive orders. I can tell you, folks, if tariffs are a big part of that, and if tariffs are big enough, I can say with confidence, I think this market is going to like that like a root canal. So we could see this very nascent breakout become a false breakout, lickety-split. It could easily go in the other direction if we don't have, that tariff threat, at least to a great degree, or at least to what was originally promised. And, the focus is on other more pro-growth things. So we'll wait and see. The thing about pro-growth, though, is that like the good jobs number a week ago, it's also pro-higher interest rates, and that's a problem for stocks. So last week I showed you my dollar chart, and I said everybody's all bulled up on the dollar, but the chart says that it's about to roll over. Now, it has rolled over some, and I did say that was bullish for equities, and you can see since we did that, it has come down, and equities have had a nice rally. More importantly, I said that the 10-year yield was, going through the moon. We were right here when we did that last week, and I said this says really good chance that yields are going to roll over, and if they do, that would be very good for stocks, and that's exactly what played out last week. We also looked at the Japanese yen. I told you we bought more of it right here. I said this is a very bullish chart, and sure enough, we've had a nice run in the yen since we bought that. And go back to last week's video if you want a narrative as to why we think the yen's going to be important to own for an extended period of time right here. And then gold. Gold was right here. When we were talking a week ago, we have broken above that resistance right there on GLD, which is the ETF that we use to express our gold position. Come off a little bit of that on Friday. Long-term bulls on gold, short-term cautious on gold, to be honest with you. So folks, probably enough rambling for one morning for you. So much more we could get into, and we will as the days and weeks unfold. Next week is going to be very, very interesting, to put it mildly. And I'll be back with my commentary with regard to that. Hope you have a wonderful weekend. Appreciate you, as always, for watching and listening. Take care. Bye-bye.